Financial Analysis of Lowe's and Home Depot by Cameron Purcell.
And Daniel Andresen.
Home Depot was founded in 1978 and is now the world's largest home improvement specialty retailer, with more than 2,200 stores in the United States, Canada, Mexico, and China. Home Depot stock is currently traded on the New York Stock Exchange. Lowe's was founded in 1946 and is now the second largest home improvement retailer in the world. It is a Fortune 500 company that serves approximately 15 million customers a week at over 1,745 stores spread out across the United States, Canada, and Mexico. Lowe's stock is currently traded on the New York Stock Exchange. The majority of both Home Depot and Lowe's stock is held by institutions and mutual fund holders. The board of directors have a direct impact on the stock price by setting a strategic plan for the future of the company. The earnings reports and other news can drive the stock price either up or down.
The after-tax cost of debt for Lowe's and Home Depot was estimated by reducing the pre-tax cost of debt by the tax rate of each respective company. The interest coverage ratio for Lowe's was 13.09. The interest coverage ratio for Home Depot was 13.79. And over the course of time, Lowe's total debt has increased each year from 2010, going from $5,080 in millions to $7,627 in millions, compared to Home Depot, which increased from $9,682 in millions to 2010, where they were at $10,788 in millions.
The capital asset pricing model is used to calculate the cost of equity. Using each month for the previous 5 years, each company's stock return is regressed against the returns on the Standard & Poor's 500 index. The formula for the capital asset pricing model is used to calculate the cost of equity in a firm. The formula is the risk-free rate plus beta of the stock multiplied by the market risk minus the risk-free rate.
Lowe's cost of equity was calculated with the capital asset pricing model using a regression model. The graph shows Lowe's stock price against the S&P 500 price on a monthly basis for the past 5 years.
The weighted average cost of capital of a firm increases as the beta and rate of return on equity increases as well. For Home Depot, the weighted average cost of capital was 8.35%. And for Lowe's, the weighted average cost of capital was 8.04%.
Changing the capital structure of a firm can lower the firm's cost of capital. Optimal capital structures can vary depending on the firm's debt-to-equity ratio. For Home Depot, the optimal debt-to-equity ratio is 40%, which would incur a 29.19% increase, while Lowe's optimal debt-to-equity ratio would be 30%, which would incur a 12.57% increase. To maximize the value of the levered firm, Lowe's would have to go up to a 50% debt ratio, but would suffer a loss in its bond rating. So to maintain, they would stay at 30%. Similar for Home Depot, their maximum value of a levered firm would come at 50% debt ratio, but would also come at cost to their bond rating.
The optimal debt ratio leads to the minimal cost of capital. If the value of the firm is the net present value of future cash flows, then the lowest cost of capital results in the maximal firm value. The cost of capital is higher with both too little and too much debt. The closest company to compare to both Lowe's and Home Depot is Tractor Supply Company. However, their market cap is only $6.87 billion and they only have 8,700 employees. They do have strong EPS earnings with 3.54.
We use the discounted cash flow technique to value the common stock of Home Depot and Lowe's. We chose this because discounted cash flow techniques are largely used by investment bankers, Wall Street traders, and Wall Street analysts to value stock. Lowe's most recent stock value is $29.59 per share, which is considerably lower than the intrinsic value of the stock, which is at $32.57 per share. This leads us to believe that Lowe's stock is significantly undervalued by $2.98. Home Depot's most recent stock value is $59.47 per share, which is lower than the intrinsic discounted cash flow valuation of the stock, which is $63.20 per share. This leads us to believe that Home Depot is undervalued as well by $3.80. Overall, based on the discounted cash flow method for stock valuation, it is apparent that both Home Depot and Lowe's are significantly undervalued, and although they are not off by much, they are not fairly valued.
Thank you for listening to our presentation.
Thank you, Papa Shiroki.